and go from there.
Thanks, Lewis. Happy to be here. Really excited to join the organization. Looking forward to working with everybody on this call. Some of you I may have already reached out to as well. So happy to introduce our guest speaker today for today's presentation. Presentation. Rob Daniel is a regional sales vice president at Securian. He's been with Securian for over 18 years, 34 years experience in the industry. He is out of Charlotte, and he also works in the advanced markets department. So he knows how to structure complex cases. And today's topic is going to fall right into his bread and butter. So without further ado, we're going to turn it over to Rob. If you have questions along the way, please utilize our chat feature to put them in. Otherwise, Rob will stop along the way for some questions. But if you have a burning question that can't wait, please use the chat feature to get it in there. Without further ado, we'll turn it over to Rob.
Yeah, I appreciate it, Steve. Thank you. Good afternoon. I hope everyone's doing well. Great to be with you. And thank you to the Best Agency for having me be part of your meeting today. So got a great topic today. We were going to talk about some estate planning techniques, especially through the tax uncertainty that we're going through. And really, there's not as much tax uncertainty because the tax bill actually got passed. So we'll go through some of that information. But more than anything, we're going to go through some strategies and give you some ideas, especially for year end for estate planning, whether it's estate planning from a tax perspective or whether it's estate planning from a beneficiary planning situation. So I'm going to go ahead and share my screen here. The material I'm going to be going through with you, I've already sent it to Lewis and Steve, so they will be sending that over to you. So, and again, as we go through this, any questions that you have throughout the presentation, I'm going to make sure we have plenty of time to be able to address those, and I'll stop along the way so we can take care of those questions. So let me get this started here. So again, we're going to talk through estate planning for clients through tax uncertainty and kind of where we are with this new bill and what we're going to do from a planning standpoint. So let's talk about taxation on a Thursday afternoon here. So the big beautiful bill finally got passed, and these are some of the highlights with it. I could almost do a presentation just on this. I'm just going to go through the highlights with it, and especially since we're talking about estate planning, the first one up is the estate tax exemption. So there was a lot of talk with us of what was going to happen with the exemption, whether it was going to stay where it was, whether it was going to revert back and sunset. Or whether or not estate taxes were even going to be part of the equation with the new tax bill. So where they settled was at $15 million per person for the estate exemption. So again, still a real high threshold with it. And with that, they made permanent the extension of the income tax rates from the 2017 Tax Cuts and Job Act. So highest rate still 37%. So in the passing of this bill, at least from the individual rates, we're still in a low tax environment. And with the state exclusion being at 15 million per person, again, it's still a favorable tax planning situation for most individuals. So just a few other bullet points with this. We got the standard deduction going from 30 to 31,500 for married filed jointly. You can see the numbers for head of household and single. So standard deduction, again, real high. There's also standard deduction increase over the age of 65 of $6,000 with phase outs, depending on your income, again, whether it's single or married filed jointly. So again, some opportunities there. The SALT cap increase. So that was a big point of discussion of the state and local tax, which was capped at 10 grand, and now it's up to 40 grand for 2025 with a phase out over 500,000 of income. But you could see with that phase out increased by 1% to 2029, and then it will revert back to 10,000 in 2030. So definitely something to take advantage of over the next 5 years. But again, definitely a positive impact on that. The extension of the 199A, which is for business owners. So again, we're not going to talk much about the business owner aspect of the tax deduction here, but that did get extended. So that was really good, especially for the corporations. Then a lot of talk around the tax deduction or the no tax on tips and the overtime. Well, where they landed was a tax deduction of tips up to 25,000 and then overtime up to 12,500 with the phase outs, with the income that you see on the screen. And then that's through 2028. And then charitable cash deductions permanent, 60% when itemizing. So again, another nice feature with that. So again, a lot of good updates with this. It took a while to get through, but overall, we're going to see that we're going to remain in a lower tax environment. So that's going to really lead well towards doing some tax tax qualified plans or really tax-free plans when you're talking about max funded life insurance opportunities. And I talk a lot about that in more advanced marketing sessions. This one, we're going to focus on that estate tax, though. And the estate tax at 15 million, that's a big one. And what we've seen throughout the year is that we've seen people hesitate doing estate plan because they didn't know where this was going to land. So you could see 2024 was at 13.6 million. This year was 13.99 million. And then now we're going to be at 15 million adjusted for inflation. So what do you do with this? And you get a lot of these clients that are maybe between 5 million and 15 million, where maybe you're talking to them about the sunset or talking to them about estate planning, but then when you got this higher now estate tax exclusion, what do you do? Well, what's the certainty with this? And we talk a lot about that with where's this going to go in the future, right? And all we know and all we could plan for is this is what we got until probably the next election, because this could definitely change in 3 years or in 10 years. And we've always had an estate tax, and it's the different exclusions have changed over the years, but we have to assume there's going to be some sort of estate tax. And there's always going to be estate planning opportunities. The hard part in today's planning is doing those ILEC cases, doing those big cases. Is your client willing to commit to something where you're gifting assets out of the estate that's irrevocable to then do this planning? And we've had a lot of clients that really want to kind of wait and see with what's going to happen in the future with this. Well, if you wait and see, okay, there are planning techniques with that, but we have to assume there's going to be some sort of tax. So what can we do with some planning that's kind of in the middle? Because if you have the really, really big estate, the $50 million estates, $100 million estates, there's a tax, and that tax rate's 40% once you get above these exclusions. So you got to plan for it, right? And for those cases, ILET planning is perfect. But what if you have these cases that are between 5 million, 10 million, 15 million, even 20 million? Because if you look at a married couple, if you do credit shelter planning, which we'll talk about, credit shelter trust planning, you really have 15 million times two. So you have up to 30 million. So again, you're talking about these estates that once you get over 30 million or projected to 30 million, ILET planning's perfect. It's the ones that are that 15, 20 million. What do you do with those? And it's going to be a big focus of our conversation today. So did want to point out the state estate taxes. So not a lot of people recognize this. They always think about just the federal estate tax, which is that 40% rate once you get over the exclusion. Well, there are a lot of states that not only you're subject to the federal tax for estate tax, that you got the state estate tax as well. So you see the states in green have that state estate tax. Some states have an inheritance tax, and then you got one state, and for those in Maryland, this may not be great news for you. You got both the estate tax, the federal tax rate, the state tax rate, and the inheritance tax rate. So you get hit from all different ends with this. So when you do the calculations for the estate tax, you want to just keep that in mind. And we have a great advanced marketing team of attorneys that can actually help through this to give some estimations on what that tax would be. And we'll talk about that a little bit at the end of the presentation. But just kind of keep in mind, sometimes it's not just the federal, it's also at the state level as well. So let's talk about flexible estate planning now and what can we do. And there's just so many opportunities with estate planning right now. We're seeing, as from a carrier perspective, I always like to talk about what we see in the industry just from that carrier perspective. And we are seeing a lot of opportunities with second I cases and estate planning cases. But what we are seeing is there with business owners. We're looking at, again, not necessarily state tax type of situations, even though we do have those. It may be more of an estate equalization type of framework where what that is maybe the best example of it is a farmer. So say you have a farmer, they've owned the land throughout generations of their family, and they want to make sure they pass that land and that family farm to their kids. but maybe only one kid's the farmer or one kid's the business, but you have other children that you want to make sure you're taken care of, but they're just not part of that family business. So how do you equalize it? So that's been a great topic here recently. We're seeing estate planning of clients that are really heavily funded with qualified assets. And as we know from the past law passing, these qualified assets, when they pass to the kids, that's when taxes are due. And it used to be you could stretch those IRAs and stretch the qualified money out to the mortality of the individual inheriting the asset. Well, now it's capped at 10 years. So again, that's another aspect of estate planning we need to think about. Sometimes estate planning, you start looking at the liability coverage, and especially if they're a business owner, whether or not, whether it's the cash value to life policy or the annuity, whether it's subject to creditor protection. So you look at those type of aspects, especially for business owners. But then what if you have that second marriage or blended families? How do you work that into the estate plan? Again, that's where sometimes it can get complicated, but you want to make sure the families are equalized and they're taken care of, especially if their taxes due. We run into estate planning cases where you have the special needs cases, and especially special need trust planning cases. Very unique. In fact, we have an attorney on staff, Mark Belitsky, in our home office, who is fantastic at special needs planning. He won't write the special needs trust, but he gives some great direction on what you could do for those family members. Worked on some cases recently with that, where they've been really just great cases where you're taking care of the family, taking care of the special needs child, but you're also providing protection within the trust planning. So definitely, if you have a case like that, Securian is a go-to carrier for that. And then you got these high net worth clients that have estate tax exposure. Again, these might be your traditional ILET cases. So I almost divide these cases where you got somebody either, 30 million above, or that 10 to 30 million, you're wondering, okay, what do I do with this, right? And again, if they're hesitating what the tax is going to be, let's have a discussion with them, because we know there's going to be a tax one way or another. It's never really, unless you're George Steinbrenner, and I always mention the George Steinbrenner case. There was a case where in the tax law where the tax sunsetted, where there was no estate tax, and in that year, George Steinbrenner, the owner of the Yankees, passed away. So that was kind of your anomaly case of somebody that passed away at the right time because there was no estate tax. So going forward, we're not going to see that. Going forward, there's going to be an estate tax. We just need to plan in the future for it in the most appropriate way. So I kind of go in a range of flexible to least flexible with estate planning, and kind of looking at what's more appropriate. And we have these 4 topics that we usually talk about, and one's actually term conversion. I mean, I'd like to talk about this in these sessions because term is sold so much for just a commodity, for just low pricing. Get some insurance, pay the least cost, and you run your spreadsheet of all the cheap term carriers, choose the cheapest rate. I really encourage you that if you're doing planning on somebody who's got a significant net worth and you're doing, term insurance for that individual, look for permanent opportunities, but also look for term insurance that's got convertible options, because you never know when you're going to want to convert to permanent. And for those cases, you're really going to want to convert to permanent and then start looking at ownership of those policies. But definitely term conversion can be a great asset, a great planning technique for you. Then we have these other planning techniques, again, from most flexible to least flexible. If you look all the way to the right, number 4, that's the ILET. That's your gift. That's getting it out of the estate, losing control, but it's not calculated in your estate. And again, love that for that 30 million plus, even the 20 million plus, because their estate's going to be growing and it's going to probably exceed the threshold. And again, not knowing what that threshold is going to be in 10 years, 20 years. But with the ILET, again, it's hard to make changes with that. So you got to look at the rules with that, and usually that is in the term irrevocable. You're not going to make any changes. You're not the owner. You have to get trustees. Well, then we got these other planning techniques. You got wait and see planning, and then you got spousal limited access trust planning. So we're going to focus on those 2 today, and focus on maybe creating a situation where if you have a client that's not ready to give up assets or gift assets, but wants to do some planning and put some permanent planning techniques in place. So let's talk about wait and see. This is one of my favorite topics. Love this technique because it provides the most flexibility, and I'm going to do a case study with this. So this is ideal for 40 to 65-year-olds. I've done it for older clients as well, but where we see the most clients on this is that 40 to 65 range, married, possible state tax issue, but it's this not ready to lose control of their assets. They want to have access potentially to cash value. They want to maybe have access to some of the living benefits of the life insurance contract, maybe for retirement, maybe for long-term care planning, but they don't want to give up that asset. They don't want to make the gift. So we have seen this a lot on cases where we got a client that may or may not be in a state tax situation. But as you know, if you have a case where they want to have access to either the cash value or a living benefit like a long-term care agreement, you can't do that in an ILA. It's very challenging to do it in an ILA. Again, we'll talk about a slat approach here next, which is one way you can do it. But the simplest way, where if you just don't want to go down that road of an ILA, is to do a wait and see planning approach where you have the client get a credit shelter trust. So this credit shelter trust, or another name for it's called an AB trust. It's this trust that's going to be created at the death of the first spouse, where it's going to save the exclusion, that $15 million exclusion that we went over earlier. This is where it's going to allow two people to use 30 million for an exclusion instead of just 15. So you got to get this credit shelter trust in place. So what happens is one of the spouses passes away, it allows you to put up to the 15 million in this credit shelter trust to kind of save this exclusion. So you use both. So how that works, and when doing what's called a two policy approach, and I'll use a case study to help with this, is say you got husband and wife want to take out life insurance policies, and they want individual life insurance policies. This is not a second to die. We're going to do individual life policies. And so you're going to name each other beneficiaries because they're married. If one of them passes away, you want the death benefit to go to one of the spouses. But the problem with that is if you have control over it, you own it. And when you own it, the death benefit's in the estate. So what we'll do is we'll cross-own these policies. So we'll have the wife own the husband's policy and the husband own the wife's policy. We're going to name each other beneficiaries, but we're going to get this credit shelter trust set up. So what's going to happen is at the first death, and let's just say the husband dies first, wife's going to get the death benefit from the husband's life insurance policy. But the problem is the husband owned the wife's policy. Well, what we're going to do is that credit shelter trust is going to get set up where then the ownership of the wife's policy is going to then go to the credit shelter trust. And then that credit shelter trust will be the owner and beneficiary. So in that sense, by that policy going into that credit shelter trust, it's not in the estate. And it really is a perfect planning technique for it. And what's also nice too is you can then still use the benefits through the HEMS presentation through the HEMS provision, which is health, education, maintenance, and support. So works out really good. So this is a way where you can actually set up estate planning without having to do the permanent gifting of the island. And again, very popular for this $5 to $15 million net worth type of client, especially if you're buying a life insurance policy that's going to be added to the estate. You could just do it here to the wait and see planning approach. So here's a case study with it. So you got Will and Jada, ages 46 and 44. And what they're going to do is they're going to write policies on each other. And they're going to fund it with $500,000 of funding in each policy over a 20-year period. So when Will dies at age 75, Jada is the beneficiary. He's going to receive the death benefit. But what's going to happen is Will's policy on Jada is going to drop down to that credit shelter trust to pay for estate taxes. But she can still access, whether it's the cash value or if you do a long-term care benefit, for that HEMS provision, which is great. It's called health, education, maintenance, and support, which is a really broad definition. So again, this is a way where you can write these two policies and not have to do the ILET, but still do estate planning. So I'm going to stop right there for a second. That's the first concept. Again, it's called wait and see planning. I saw some things come across on the messaging on the presentation, so I want to stop here. Can I address any questions? Any questions?
I
Okay,
did
well, time
see
for questions. Yes.
I did see one on the chat. Yeah, and Della, yeah, I do have a copy of the slide presentation, so we will be able to get that to you, at the end of the presentation within the next, I would say, give me at least 24 to 48 hours to do
Okay.
so.
Perfect. Perfect. So what I'm going to do is I am going to move from this presentation here for a second. I'm going to stop sharing and I'm going to do a case study here really quick. And this will kind of show you how we do this. And I'm actually going to use, so this case study actually was mirrored off of a case that we did recently. So this is an example of Securian's Eclipse Protector IUL policy. So for those who are not familiar with Securian, we are one of the highest rated life insurance carriers on brokerage. You can find 96 Comdex rating. We specialize in index universal life insurance. And that is either in a cash accumulation type of policy or as a death benefit guaranteed policy, and especially with a long-term care agreement. So this is actually our Eclipse Protector, which is the protection IUL contract. So this case study mirrors what I just showed you on the presentation. Imagine this is Jada's contract. She's 44 years old, preferred select, and we did this $25,000 premium as a 20 pay to buy as much death benefit as possible, guaranteed for life with an age 120 guarantee. So when you look at our illustration, you'll see the premium on the left. You see the death benefit on the right, which is 2.432 million. And you see this asterisk to the right. What that asterisk means is there is a no lapse guarantee. It means that I don't care what the index does from a performance standpoint. She pays this premium. The policy is guaranteed for life, even though we are doing a short pay, which, by the way, if you've run Securian before, the niche with us is no lapse guarantee IUL contracts on a short pay or a 1035 exchange. We probably will be number one or number two on almost every scenario. Even on life pays, we're extremely competitive and we'll be in the top three, but we usually win these short pay cases. And this case study was actually mirrored on one that we actually did as a real case. So you see, this is, again, for simple protection case, but imagine if both Will and Jada, in that case example, each did a contract like this, right? They each policy, similar face amount, guaranteed for life, $25,000 a year, 20 pay. They didn't want to pay it in retirement, assuming they'd live long, and they're done paying premiums, and then they have all this cash and all this death benefit. Now, one of the reasons I ran this as a protection case, this policy has a long-term care agreement on it. And this is actually new with Securian, and I've been doing a lot of wait and see planning with this. One of the questions is how do you get life insurance on an individual where you're doing estate planning, but you also want to put some long-term care coverage on it, but we don't want it in the estate because of estate planning issues. And there's always been this issue of, do you put whether it's a linked benefit or a long-term care agreement in an ILET because you don't want to own it because of estate tax issues. And this is a way you can get around it, really, because we're going to cross own it. And so each other owns the policy. They basically, in this scenario, have a $2.4 million pool for long-term care. And if Will dies first and she gets the death benefit, well, then he owned her policy. Well, her policy then reverts to the credit shelter trust ownership, and then she can access the benefit for long-term care through the HEMS provision, and it's still sitting outside the estate because we use that credit shelter trust. This is a great planning technique. Now, again, new with Securian, we just introduced a long-term care agreement. Now, we have a chronic illness agreement already. We've always had that. It's been real popular. Indemnity benefit, 2 or 4% monthly benefit is a great benefit. This new rider, which is approved in all states except for California, Oregon, Montana, and New York, it allows you access either as a 2, 4, or 6-year benefit. And I put a 6-year benefit on this. And you could have 100% of the death benefit accessible indemnity cash of the full death benefit here. So she would actually have access to the 2.4 million in long-term care. So one way or another, we're paying the 2.432 million. It's either early for long-term care or it's for death benefit from an estate planning situation. So, or a little of both. So love this aspect from a standpoint of how do you do long-term care and still do some estate planning at the same time and getting it out of the estate. I'm going to stop right there. Any questions? Okay, perfect. Let's do this in another way. And this was actually not on the PowerPoint, but this is something that we also do a lot too. This is wait and see planning, but with a survivorship policy. So a lot of times when you think estate planning, you think of a second to die policy. Well, we showed you a 2 policy approach. Here's a 1 policy approach on doing the same technique. So this is 2 70-year-olds, male standard non-tobacco. The wife is 70 preferred non-tobacco. This is mirrored to a real case I'm working on. This is a $3 million death benefit on a survivorship. And where I actually got that premium was the client has a lot of qualified money and doesn't need it all for income. This is almost like an RMD type of case where they're using the required minimum distribution to pay for life insurance to create leverage. Now, the issue is very wealthy family not knowing where the estate tax law was going to be. They really would like to create leverage for their family, especially paying tax on their qualified dollars that's going to pass to them that needs to be paid in 10 years. But how could we create that leverage to do that? Well, we use the RMDs to pay for it. But what we did, not wanting to do an ILET, we did a wait and see 1 policy approach, which says we're going to have the mortality inferior person own this contract, which meant in this case, we picked the male. And all that means is we think the male is going to die first. So if we set this up with the husband owning the policy and the beneficiary is the credit shelter trust, this works fantastic. So if the male or the husband dies first, okay, so he owned it. So what happens here? Well, we got that credit shelter trust set up. If he owned it, we just revert the ownership to the credit shelter trust. So it then becomes owned by the credit shelter trust. The beneficiary is the credit shelter trust, and we fit it within the $15 million coupon of the estate exclusion. So again, you don't need to do an ILET with this case. Now, question is could you at one point move this to an ILET later at life? Well, sure you could. You just got to gift it in, and it takes you 3 years to gift it in. So, you got to watch that, right? But you could make that gift. And again, you got to talk to the estate attorney about the gifting ability for doing that. But the wait and see, you really don't have to, because as long as it fits within the credit shelter trust and you get that set up, it works very well. And you can see here, $73,000 premium. Literally what this is they're basically taking a little over 100,000 out from their RMDs. They have a lot of qualified money, and we're just paying a premium for life into a guaranteed SIUL. And again, Securian's really competitive with the pricing on this as well. So again, we figured out a solution for how they funded it, who owned it, and then taking care of the estate planning, not knowing where we're going to be with estate taxes, but we did know for certainty that we knew we were going to have taxes on the qualified money passing over to the kids. So from that standpoint, this took care of a lot of planning opportunities in 1 technique. Again, I'm going to stop here. Any questions? Okay. So I'm going to go back to the PowerPoint presentation, and we are going to talk about slats. Okay. So let's talk about what a slat is. This is perfect for a 40 to 60-year-old. We got a lot of cash. We want to do maybe an accumulation type of sale. Worried about estate taxes, but doesn't want to give up control. Wants access to the cash value, but maybe as a business owner and they want what's called asset protection. So this is a situation where we've done it. We've done this again, both accumulation and protection. I really like this on the accumulation type of cases. All this says is we got a married couple, and again, to make this work, you really want to make sure they're not only married but also a happy marriage. Because what we're going to do is we're going to set up an islet in this case. This is going to be something where we're going to gift premiums into this. So this is a little less flexible than wait and see, but you're going to see that we build in some language for flexibility. So this is going to be an islet. So we're going to make that gift to that islet. And we got that non-grantor spouse, and we got kids. Okay. So the islet's going to own this. The islet's going to be beneficiary. But what we're going to do is we're going to provide language to say that the spouse will have access to the cash based on the HEMS power, which is health, education, maintenance, and support. So again, this is for people who think they potentially could have an estate tax issue. They may want access to the cash. So what we're going to do is take this policy out, in this case, Derek and Meredith, age 50 and 48. We're going to take that policy out on Derek. And this is going to be a max funded case with $47,000 a year for annual premium for 20 years on a minimum face contract. So it's going to be built for efficiency to grow the cash. We're going to name the spouse and the kids beneficiaries of that slat. But during both their lives while living, Meredith can access the cash value for herself and for the kids using that HEMS power. I've used this for the retirement planning. We've used it maybe for college funding for the kids. And it's a great resource, especially for that tax-free cash, because you could take the cash out tax preferred using policy loans from the accumulation design. But again, use the cash for their living. But if there's a death, then you got the situation where that policy then is going to be paid into the slat, and that slat's going to be outside the estate, filling up the coupon for the estate exclusion up to 15 million. So again, great technique, a little bit more or less flexible because of the eyelet. But where I see these cases is if Derek especially is a business owner, and having that policy in the eyelet actually provides the best creditor protection just in case his business gets sued. So again, creditor protection on this is usually really important. Now, with that, I will switch presentations here, and I'm going to actually go to the case study I have prepared for this, and we'll finish up with this real quick. So this is an example of our Eclipse accumulator IUL. So this is what I use for these slat cases. So this is actually the example of this 50-year-old male, preferred, $47,000 a year going in for 10 years, minimum face, increasing death benefit. And as soon as we stop paying premium, we lower the face, we level the death benefit. And you'll notice I'm showing two scenarios. I'm showing one with distribution, which is almost $72,000 a year tax-free up from age 65 to 90. But then I show another one without distributions. I'm just showing a pot of cash. Now, the reason I show both is the client could do either one, right? So it's a great source of cash. And I kind of call this the tax-free bank account, especially for a business owner. But what's so nice about this is we get this set up as a slat in this islet. It's outside the estate, full creditor protection. But we can either access it as a yearly income for retirement, or we can access it whenever we want. And what I'm seeing now in the marketplace is they want access anytime they want. And I'm not really running a lot of these max distribution cases you see on the right. Now, the reason is, and I'll just kind of give you a scenario. So back earlier this year, market was very volatile. And what if you were somebody getting ready to retire in March What was the stock market doing in March? Well, it was all over the place, and it was all over the place down as well. You saw some down 15, down 20% numbers. Now, again, it's recovered, but there's been some volatility. What if a client retires when the market is down? Do they want to sell shares in their 401k or IRA on a down market when they start retirement? And one of the things that I really like about the planning on the accumulation side is, again, you could take that annual income like that out in scenario two there on the right, but what if you just use the accumulation life insurance idea as a buffer account that, and this is the power of doing what's called an index universal life insurance policy on an accumulation design. These policies have what's called a 0% floor, meaning you can't have a negative rate of return. So when the market's down, would you like to take your retirement income off of a zero floor account? Plus the fact that when you take the money out, it's tax free. And so we've been encouraging people, again, whether you call it a buffer account or whether you call it a bond replacement account, is create life insurance as an asset class and have that as a separate, different asset class that when you compare it to your 401k or your IRA, which most of the time is invested and it's in the market and it's exposed to the market on the top end, but it's also exposed on the down end in negative years. Have that zero floor asset that has the upside with an index that you could take out tax-free, but use it as a buffer account. And if you can combine that with doing some estate planning, what you've done is you've used one product or one planning technique for multiple planning opportunities within the financial plan. And what I feel like I showed you today in this presentation is ways where you can almost take one policy and have it for multiple purposes in the financial plan. It could be for estate planning. It could be for retirement income planning. It could be for long-term care planning. I do a lot of business planning presentations or personal planning presentations where you're looking at a lot of different concepts. Again, it's estate planning, beneficiary planning, retirement planning, tax planning, risk management. Sometimes these plans can be combined to take care of a lot of things at once. And I like doing that from a planning standpoint. And especially with some of these techniques, there's some really good opportunities out there. And definitely this is one of them. So again, as a recap, talk to your clients and work with your clients with what the new tax laws are and the impact on them, not only now, but in the future. Talk through those estate planning opportunities of whether or not it's estate tax or maybe estate beneficiary planning and how they would like their estate passed. And what are the tax impacts of whether it's their estate or their business passing to the next generation? And whether or not life insurance can be used as a leverage tool, whether it's from a protection standpoint or whether it's from an accumulation standpoint to enhance that financial plan. And then watch ownership of it, right? So that ownership is real key. So if we're getting close to some of these thresholds, the wait and see approach or the SLAT approach is great. But then also you got the asset protection approach too, in the SLAT that could just be very beneficial, especially if there's a worry from a business owner on their estate getting sued. So again, went through a lot of topics today. I'm at the end of my presentation, so we're going to open up to questions. But again, really appreciate the time today. Again, a lot of great opportunities. One of the reasons I go through this presentation is usually with these opportunities, you'll find some bigger opportunities. And that's what agents are looking for is where's that next big case or where's that next big opportunity. I see that with these estate planning techniques, but I also see too, it's really good, smart planning techniques that you could really help a client forward with their planning. Any questions?
Rob, thanks. There was a question in the chat field. Someone was asking about marketing materials available, and for sure we can send this presentation, as Lewis mentioned, along with the case studies, as well as some product information that we can send. But they were asking also specifically about social media marketing. Does Securian offer anything like that?
Social media, we do some things on LinkedIn. We are limited to what we could do with some of that stuff. So I'm going to share a screen with you here that hopefully will help with some of that. Bear with me here. me get the technology to work here. Hold on a second. Hold on. Of course, I got to get the technology to work where it shares my screen, right? There we go. So this is it. This is the access to the resources. So if you actually go to www.securian.com/epic, or you could do that QR code, that actually will get you to our estate planning microsite. All the material I went through today is on that microsite, as well as some really good one-pagers with this. And I will make sure I send that to both you guys so you could pass it out. So, but the one-pagers are great. In fact, we have one-pagers not only just for the client, but for the agent, for the attorney drafting the credit shelter trust. So great material for that. Yeah, again, check out LinkedIn for us and just go to Securian where you'll see some stuff with that. But the best resource for all of this is that microsite. And again, for those who have gotten an email from me, and again, Steve, you could see this on my signature, my email. I have a landing page link, and the landing page link in my signature, my email has access to all this as well. The other access that you have is a few attorneys here. So this is our team of attorneys. With Securian, we have a lot of great knowledgeable people with our company. And you could see from the director of sales, Ann Haggerty, she was the one that created this PowerPoint. But Mark is my go-to on wait and see and ILET planning. He's also really good at business planning and split dollar. And then myself and Sarah are actually some of the advanced case designers that can actually help with the illustrations. We got a great team to be able to help with this. And again, a lot of resources we can provide.
Thanks, Rob. Another question has come up. Will we get a copy of this presentation? Yes, Don, we will send out a copy of the presentation along with the case studies, as well as a reminder for these some of these resources that we have available. Also, Best Agency does belong to an organization called Libra, which has another exclusive deal, if you will, for working with the advanced sales attorneys that Rob just mentioned. So we do have a dedicated person. So please reach out to either myself or Lewis, and we can definitely get you connected with the right person. This presentation was recorded and will also be available on YouTube. Again, we ask that you give us about 24 to 48 hours to have that posted up there after we do a little bit of editing and all the fun stuff. So again, thanks, Rob, for your time today. Any last questions before we sign off and while we still have Rob on the call? I want to thank everybody for their time today. Rob, thank you again for a great presentation. Very informative and a lot of information to know. So please, again, reach out to myself or Lewis here at Best Agency. We look forward to helping you with your estate planning cases and any other case that you might be working on. We'd love to help you out. One last thank you for everybody for attending. One last look for any quick questions. Fantastic. Rob, thank you very much. I hope everyone has a great rest of their day. Thank you all for joining.
Yep. Thanks, Steve. Thanks, Lewis.
Thank you.
Thanks, guys.